In this video, we will be discussing if prop firms are worth it. Stick around to the end to receive a free trial of our prop firm passing bot, which includes 7 days of free access and a phenomenal strategy guidebook on how to pass prop firms automatically. So, a common question in the world of trading is if the new age prop firms, think FTMO, funding pips, the whole online prop firm space, is actually worth it. And quite oftentimes people will tell you, oh, prop firms, they're simply a different form of leverage. They will also quite often discuss the rules and say that perhaps they might not be viable or the rules are too strict to enable proper trading. So in this video, I wanted to dive in a little bit more into detail in regards to what people mean by them being leverage providers, as well as discuss the rules and contrast prop firms with more of a standard brokerage account and look at the pros and cons of both. So, really to start us off, I really share the opinion that these modern day prop firms, think FTMO, funding pips, Blueberry funded, not Blueberry markets, and the Fivers are all simply leverage providers. So similar to how any broker will give you 1 to 200 leverage, and some brokers will even give you 1 to 2,000 times leverage, depending on which jurisdiction they're based in. Prop firms in some ways have some similarities because frankly you deposit a small amount of money and they give you a large account, but that account can often be looked at as an alternative method of leverage where you're getting more favorable leverage conditions. However, the downside is you need to go through a certain amount of rules and you also need to go through a challenge phase, and the majority of people never make it past the challenge phase and they would lose their deposit. But just to frame the rest of the conversation today, let's chat about prop firms really as leverage providers and just contrast them to brokers through that lens. So, to start off discussing the rules, I pulled 2 different examples here. One from FTMO, which is likely the industry leader, and this would be an example of their standard 2-phase evaluation. And I also have a clip of Blueberry Funded, which is a very popular new prop firm started by the broker Blueberry Markets. So also a large company which has branched into the funding world. The Blueberry approach, which is on the right, would be a 1-phase, whereas the FTMO is a 2-phase. And I'm sure you're all rather familiar with prop firms, but maybe as a quick refresher for those who are not, in all of these models, you effectively buy a challenge, which gives you access to a certain account size. With that, you have to meet a certain profit target, and upon meeting those profit targets, you're given a like a quote-unquote live demo account, which you're able to trade with and receive the majority of the profits made on that account. Often it's 80% profit split, as we can see here. Some of them offer you 90% or even 100% profit splits, depending on the exact firm. But really the mechanics of it, let's take a $10,000 account. You would pay around 166 US dollars as a fee. And in terms of what you would receive a $10,000 virtual account, of which you have a maximum loss of $1,000, and your profit target here would be 15% across both phases for FTMO. Whereas if we look at the 1-phase account, you typically have a lower profit target of 10%, but your max total loss would only be 6%. So really you're paying for whatever the max drawdown would be, and all the rules tend to flow off of that. But for the purposes of this video, let's continue with the FTMO model, simply because they are the market leader and most people would have at least tried to start with FTMO when they're beginning their prop firm journey. So really here, to go through the point of them being leverage providers, I wanted to contrast a prop firm versus a standard brokerage account. So taking this $10,000 FTMO account example, you as the trader would pay $166 for a $10,000 account, and your max drawdown is really $1,000. So I've heard in the trading space before that effectively, oh, you're only getting access to the amount you can lose. So you're not getting $10,000, you're getting $1,000. But my argument there would be, or what many people would say is, okay, that's fantastic. You're still getting a 6x return on your capital. So just by using their initial leverage, even if we take the minimum, like the downside scenario of you're paying for your max drawdown, that's still a 6x return on your capital before you necessarily even have to make a return, assuming obviously you pass the challenges. On the brokerage account side, if you wanted to leverage $166 into $1,000 or into $10,000, you're more than able to do that as well, but you would have to apply a significant amount of leverage. So 166 to 10,000, you would to 1,000, you would need to 6x leverage, whereas with 166 to 10,000, you would need to 60x leverage. And this is effectively like, this wouldn't be referring to the amount of leverage you have to use in any particular trade. This is referring to the amount of leverage you would need to use just to match the trade size in the prop firm. So let's say in a normal account where you would have $1,000, you would be trading with one lot. And that one lot assumes the use of leverage in order to make a significant amount of money. Granted, one lot's enormous. Please don't do that. This is purely an example. Under the brokerage model, if you were trying to match the prop firm account, you would need to be trading with 6 lots. So for the same amount of firepower, if you're not using a prop firm, if you're purely using broker leverage, you will have to use significant amounts of leverage, likely over leveraging, to come close to the potential payouts from the prop firm. So there's no such thing as a free lunch. So what's the downside here? Effectively, as a prop firm, let's say downside, you're still 6xing your capital. There is a significant risk that you will never actually get that account. I think upwards of 99% of traders never actually get a payout. Therefore, you need to apply a risk weighting factor to this 6x on your capital, knowing that yes, in the event that I pass, just from a mathematical perspective, you're getting a very phenomenal leveraging opportunity on your money. But you have to also account for the risk that you would simply not get anything. But to wrap up this particular slide, it's essentially impossible to argue that normal broker leverage can beat prop firm leverage, assuming you actually pass the challenges, right? Because here for $166, your ability to leverage without getting margin called is infinitely higher in a prop firm than in a brokerage. Because to be able to trade with a $10,000 account, you would have to use 60 times leverage without using any of these like prop firm rules. And then if you were to leverage 60 times on $166, and this is 60 times on your normal amounts of leverage, if you were to have like a normal 2% loss of your account. So let's say you're trading normally where you risk 2%. If you take that and you multiply it by 60, suddenly it's 120% loss. So to be able to make similar returns, like mathematically, one loss would blow the account. So I hope this is making sense, but it's effectively showing that the leverage obtained through prop firms is so superior to anything that's available out there that if you can pass the challenges, it presents an absolutely phenomenal opportunity. And here's also an example of just what over-leveraging actually looks like. So this is the same strategy, risking 2% per trade relative to risking or compared to risking 12% per trade. And it doesn't show super well in the graph. It's just because when you zoom out, equity curves always look fantastic. But here effectively, if you were to risk 12% per trade, you would even sometimes have a relative drawdown of in the tens of percent. So you can get quite heavy, like depending on simulations, anywhere from 30 to 50% drawdowns. And that poses a significant risk of margin call. All of this to show that trying to get the same amount of money from a trading account through the use of broker leverage or through normal leverage relative to a prop firm will likely lead to over leveraging, which would have very significant drawdowns. So To wrap up this presentation today, I wanted to discuss the pros and cons of both, as personally I'm a huge fan of traditional brokerage accounts as well, and I do the majority of my trading through them actually. So the real benefit of brokerage is you have no restrictions and you don't have to worry about not getting paid. With brokers, provided you're using a good broker, the odds are you will receive your money. And at the same time, you don't have to worry about the solvency of the company going under, particularly if you're in a regulated brokerage account. And frankly, with brokers too, you have more drawdown flexibility, so it's not a binary outcome. Quite often, people will miscalculate or do something which would cause their accounts to have a drawdown higher than expected. With the brokerage accounts, you would just take a slightly rougher drawdown and you would recover. But in a prop firm, you would lose the account. On the other hand, prop firms give you mathematically amazing leverage because you're able to use significantly higher trade sizes without risking the blow up of your account in the same way. As my example earlier, you needed to use 60 times leverage to have roughly the same trade size. That is extremely dangerous for over leveraging and for blowing your accounts, and prop firms really solves this issue. So the general takeaway here is that they both have their place, but if you have a good trading strategy with a proven edge and with good drawdown management, prop firms offer a form of leverage never seen before, which presents a phenomenal opportunity which should definitely be explored. So, to wrap us up now, I would encourage you to come over to our WAP page and check out our Past Prop Firms bundle. We're currently offering a 7-day free trial on this Past Prop Firms bundle, which includes 2 expert advisors configured to trade prop firms, meeting the risk requirements, but also a proven guidebook and video lessons and strategies which will help you pass prop firms. So encourage you guys to check it out and let me know what you think. Take care.